Put $10,000 into an S&P 500 index fund and leave it alone for 30 years. At the long run average, it becomes about $189,000. You added nothing. You did no work. Nobody handed you a paycheck. So $179,000 appeared. And the question nobody asks is the obvious one. Who paid it? Because money does not multiply on its own. Nothing in a bank vault gets bigger by sitting there. Somebody somewhere did something real, and the amount in your account is your share of it. Today I want to show you exactly where that money comes from. Once you can see the machinery, a lot of things that seem mysterious about investing stop being mysterious. I'm Tom. This channel is about real personal finance, the kind that works for normal people instead of the kind that sells you something. No motivational fluff, no fantasy returns, no get rich quick, just what the math actually does over time. If that is what you want, hit subscribe. Start with what you actually bought because most people have never thought about it in these terms. An S&P 500 index fund is not a financial product in the way a savings account is a financial product. It is a list. The list holds the 500 largest publicly traded American companies: Apple, Microsoft, Johnson & Johnson, Walmart, Exxon, Coca-Cola. The companies whose products are in your house right now, and whose logos are on things you used this morning without thinking about it. When you buy the fund, you own a slice of every one of them. A very small slice, but a real one, with your name behind it. You are a shareholder in the same legal sense as anybody else on the register. So the question of where the extra money comes from has a concrete answer. It comes from those 500 businesses doing what businesses do, which is sell things for more than it costs to make them. The money travels through 4 specific channels. They are not the same thing, and 2 of them get confused constantly. The first channel is the one people forget entirely, and it is cash. Many of those 500 companies take part of their annual profit and mail it to their owners. That payment is called a dividend, and you are one of the owners. This is not an abstraction. In the 12 months ending September 2025, S&P 500 companies paid out $665 billion in dividends. That was a record, and it was up nearly 8% from the year before. $665 billion of actual cash moved from company bank accounts into shareholder bank accounts in 1 year, spread across roughly 500 companies that averages over $1 billion each, paid to people who did nothing except own a piece of the business. If you own an index fund, some of that arrived in your account. You probably never notice because most funds automatically use it to buy more shares. And this channel is much larger than people assume. S&P Dow Jones indices ran the numbers from 1926 through early 2025. Dividends made up about 31% of the total return of the S&P 500. Read that again. Almost a third of everything the American stock market has produced over a century did not come from the price going up. It came from companies handing cash to their owners. That is the least mysterious money in this entire video. Somebody sold something, made a profit, and mailed you a portion of it. And you can see the size of it directly by comparing 2 versions of the same investment. Take $10,000 and follow only the price of the index for 30 years. It becomes about $80,500. Now take the same $10,000 and reinvest every dividend along the way. It becomes about $194,000. $114,000 of difference on the same index over the same 30 years. That gap is nothing but due to buying them more shares, which then paid their own dividends. Most charts you see online show the first number. Your actual account, if you leave it alone, follows the second. The second channel is the companies getting bigger. A business that earns $10 billion this year and $12 billion next year is worth more, and the price of its shares reflects that. This is the engine underneath everything. Not sentiment, not trading, not anything clever. Companies invent products, open locations, enter countries, improve their margins, and earn more money than they earned before. Look at what that looks like in practice. Coca-Cola sold soda in the 1960s and it sells soda now. It also sells water, juice, coffee, and sports drinks in roughly 200 countries. Apple sold computers, then phones, then services that bill you monthly. Everything to do with the curious, raise the profit, and the profit is what the shares are a claim on. Over the last century, the earnings of American companies have grown at a fairly steady clip. That growth is the most reliable of the 4 channels. It is also the slowest to notice because it happens 1 quarterly report at a time. The third channel is the one almost nobody explains, and it is now larger than dividends. It is called a share buyback, and the mechanism is simpler than the name suggests. A company takes its profit and buys back its own shares from the market, rather than mailing that cash to owners as a dividend. Those shares are then canceled, so the profit stays the same and there are fewer slices dividing it up. Every remaining slice, including yours, represents a bigger piece of the same company. You did not buy anything. Your ownership percentage went up because the number of owners went down. A simple version makes it obvious. Imagine a company worth $100 split into 10 shares. Each share is worth $10 and owns a tenth of the business. The company uses $20 of its cash to buy back 2 shares and cancels them. Now there are 8 shares left and the business is worth $80. Each remaining share is still worth $10. But it now owns an eighth of the company instead of a tenth. Nothing was created. The pie was cut into fewer pieces, and the people still holding pieces got larger ones. The scale of this is enormous, and it is a genuinely recent development. In the 12 months ending September 2025, S&P 500 companies spent $1.02 trillion buying back their own shares. That is a record, and only the second time in history the figure has passed $1 trillion. Add the dividends and the buybacks together. Those 500 companies returned over $1.6 trillion to their owners in a single year. That is where the extra money comes from, not from a chart bending upward. From 500 businesses generating cash and sending it back to the people who own them. Before the fourth channel, it is worth stopping on how ordinary the first 3 are. None of them involves a trading floor, or a forecast, or anybody being clever. A company sells something for more than it cost. Some of the profit gets mailed out, some gets used to shrink the share count, and some gets reinvested to produce more profit next year. That is the whole of it. 3 of your 4 sources of return are just commerce, happening in warehouses and offices and factories, most of it while you are asleep. Now the fourth channel, and this is the one that causes almost all of the confusion. The fourth channel is other people changing their minds about what the same company is worth. Suppose a company earns $10 a share. Last year, investors were willing to pay $150 for that stream of earnings. This year, they will pay $200. The company did nothing differently. It earned the same $10, but the price rose 33%, and if you owned it, you got 33% richer. That is called a change in valuation, and it is the fourth source of your return. It is also the only one of the 4 that is not connected to anything real. Jack Bogle, who created the first index fund available to ordinary people, called this the speculative return. The other 3 he called the fundamental return because they trace back to business activity. This one traces back to mood, and it is enormous over short periods. Look at 2 decades side by side. In the 1970s, investors got progressively more pessimistic, and the falling valuation subtracted about 8.3 percentage points a year from returns. In the 1980s, they got progressively more optimistic, and the rising valuation added about 8.2 percentage points a year. Same country, same corporate machinery, more or less. 2 decades where the mood alone accounted for 8 points a year in opposite directions. Now notice what those 2 numbers do when you put them next to each other. They nearly cancel. That is the single most useful thing to understand about the fourth channel. Over a decade, it can dominate everything else. Over 30 or 40 years, it tends towards 0 because valuations are bounded. People cannot become infinitely more optimistic forever. Before I assemble the answer, there is one more piece, and it explains why these 4 are not really separate. Companies do not send you all of their profit. They keep a large share of it, and that retained money buys factories, funds research, opens locations, and pays for acquisitions. Those are the things that produce next year's higher profit, which is Channel 2. So Channel 2 is financed by the profit that did not reach you through Channel 1. The money you were not paid this year is what generates the larger payment later. That is the actual loop underneath the word compounding. And it runs inside the businesses before it ever shows up in your account. So here is the whole answer, assembled. About a third of your long-run return is cash the companies handed you. Most of the rest is those companies earning more money than they used to. Some of it is your ownership share quietly increasing as companies buy back stock, and a piece of it is other people's opinion. That feels like the most exciting part in any given year, and it mostly washes out if you wait. Nothing in that list is magic. All of it is somebody working. Now let me answer the question underneath the question, because I think it is what people are really asking. Why does it accelerate? If companies grow their profits at a steady rate, why does the account balance curve upward instead of climbing in a straight line? The answer is that the growth applies to a growing base. A company growing profits 8% a year adds more dollars in its 20th year than its first. 8% of a large number is a larger number. Your slice does the same thing. And on top of that, the dividends get reinvested. The cash the companies mailed you buys more slices, which produce their own dividends next year, which buy more slices. That is the compounding part, and it is worth being precise about it. It is not that your money grows faster over time. The rate stays the same. What changes is the size of the base the rate is applied to, which means the acceleration is not a bonus that kicks in later. It was there the whole time. Put it in the plainest terms available. In year 1, your slice of 500 companies is small, so your share of their profit is small. In year 30, your slice is large, because 30 years of dividends and buybacks have been quietly enlarging it. The companies did not start working harder for you. You simply came to own more of them. It only becomes visible when the numbers get large enough for you to feel the difference. Now let me be honest about the parts of this that are less comfortable, because a video that stops here would be a commercial. The first is that none of this is guaranteed. Companies fail, and they fail constantly. The index quietly removes them when they do. The S&P 500 today shares very few names with the S&P 500 of 1970. That turnover is a feature rather than a bug, because it means her money keeps migrating toward whatever is currently working. But it also means the 10% long-run figure describes a list that has been continuously replacing its own contents. There is a version of that turnover worth picturing, because it sounds abstract. Kodak was in the index, so was Sears. So was General Motors before its bankruptcy, and Lehman Brothers before it disappeared entirely. An index fund holder did not have to sell any of them, or notice, or make a decision. Each one shrank until it dropped off the list, and something growing took its place. That is the part people miss when they worry about picking the right companies. The list picks for you continuously on the basis of what is actually working. The second is that a century of American returns is one sample from one country in one unusually good period. The United States was the best performing large market of the 20th century. Building a plan that requires that to repeat is a choice, not a certainty. The third is about that fourth channel again, and it cuts against you as often as for you. Buy when valuations are high and retire when they are low. And the mood component works against you for your entire investing life. That has happened to real people. Somebody who invested through the 1970s watched exactly that. The fourth is about a word I have been using loosely, and it matters for planning. 10% is the nominal figure. Inflation takes roughly 3 points off it. The number that describes what your money can actually buy is closer to 7%, and that is the figure I use throughout this channel, which means one of your 4 channels is partly an illusion. Some of the earnings growth is companies charging more for the same thing because everything costs more. That shows up as profit growth, and it is not the same as producing more. And the fifth is the one people find hardest to hear. The earnings growth underneath all of this depends on companies continuing to increase their profits that is held for a century. It is not a law of physics, and there is no rule saying it must continue at the same pace. So what should you actually take from all this? The first thing is that you are not gambling, and you are not being given something for nothing. You bought a share of the profits of 500 businesses, and those businesses paid you $1.6 trillion last year. Whatever else happens, that is a real economic relationship rather than a lottery ticket. The second is that the most exciting part of any given year is the part with the least substance behind it. When the market rises 20%, the temptation is to feel clever. Most of that 20% was other people's opinion, and opinion reverses. There is one more thing this framing changes, and it is about how you read the news. A headline saying the market fell 3% is telling you that people revised their opinion of the same 500 companies. It is not telling you those companies stopped selling anything. The truck still left the warehouse that morning. The software licenses still renewed. The dividends declared last quarter still got paid. Channel 4 moved. Channels 1, 2, and 3 carried on exactly as before. The third is the practical one. Most of your long-run return comes from earnings growth, dividends, and buybacks. So the useful thing is to own as much of that as you can for as long as you can. and to pay as little as possible for the privilege. That is the entire case for a low-cost broad index fund, stated without any of the usual sermon. It is not that indexing is clever, it is that the companies are producing the money. Every dollar you pay somebody to stand between you and those companies is a dollar of that production which never reaches you. So, one more time, and in the plainest words available, where does the extra money come from? It does not come from the chart. It comes from a company in Ohio shipping a truckload of product on a Tuesday, from a software license renewing, from a bottling plant in Atlanta, from 500 organizations employing millions of people and selling things for more than they cost. Your account grows because you own a slice of that. And it grows faster over time because the slice keeps getting reinvested into more slices. There's nothing mysterious in the machine. There's just a very long list of ordinary work and a claim on it with your name on the certificate. The compounding part is that the claim keeps getting bigger because the proceeds keep buying more of the claim. That is all it has ever been. If this was worth your time, hit subscribe. I will see you in the next one.